Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 36 of our YouTube channel and podcast, and I could not be more excited to continue talking with you guys about personal finance topics and just helping you walk through your personal financial life. Having already gone over some things that you could invest in, this week I want to focus on things that are either mistaken for investments or are just terrible investments in and of themselves, or just bad investments in and of themselves. And so today we're going to begin that focus on something that most of you have heard of, and that is investing in gold. And so today we're going to talk about investing in gold because that is an oxymoron in and of itself, because gold is not an investment. And I'll explain to you why. But before we get started, go down below, click the subscribe button, like this video, leave me any feedback in the comments as we go along in this video. If you're on Apple or Spotify podcasts, if you could just subscribe there and leave me a review, that'd be really awesome. Also, follow me on social media at MNO with Dylan. And I put out a lot of good content there. And then if you're interested in financial coaching and working one-on-one with me, you can check that out at our website, www.mnowithdylan.com, and sign up for a session there. So let's dive right in to gold and why it is not an investment, and even the occasional argument for gold. We'll cover that as well. So first and foremost, what is the argument for gold? Like, why do people even see this as an investment? Well, the argument for gold is that it maintains its value over time. And to be fair, it has maintained its value over time. And it maintains its beauty. It does not corrode. It does not fall away. Gold will remain gold. And so that's a reasonably good argument as to why somebody would put their money into purchasing gold, because it's going to be around. It's going to be there. There's a lot less uncertainty when it comes to whether your gold will be there and whether your gold will have any value or not. And then also there's the argument of when the dollar is weaker, gold is stronger. And so as the dollar weakens, which it did heavily between 1998 and 2008, individuals flocked to gold to maintain the value of their money. And so gold actually went up quite a bit over that time period. And so as people flock to it, obviously the prices rise. And so when the dollar was weaker, then gold was stronger. And so that's an argument for gold in and of itself. The price of gold nearly tripled between 1998 and 2008, and it hit the $1,000 per ounce mark in early 2008. And then by 2012, it had almost doubled again, and it was in the 1800 to 1900 mark. And so you could see with the systematic weakening of the dollar, gold was getting stronger as far as its value. Then another argument for gold is that it is an inflation hedge. And what this means is that when the cost of living increases, well, gold will increase in price as well. And that's counter to what you see in other financial markets typically. And so as the price of living is going to increase, you're also going to see the price of gold increase historically. In the past 50 years at least, that is what we've seen of gold. During really high inflation years like they saw in the 70s and 80s, the stock market really struggled. But gold was high flying during those years. And so you see how these arguments start to pile up as to, well, hey, let's see what gold can do for our portfolios. Then a couple more arguments. Well, one, people say, well, it helps to hedge against geopolitical uncertainty. So when there are crises in different countries, and when countries aren't getting along, and when the U.S. isn't getting along with other countries, then you'll see the price of gold rise because people think that that's where they can find value when certain countries' currencies are being hit real hard. And so that's another argument, not as big of an argument as the others, but that's one. And then this last argument is actually a really big one, and one that I can almost get on board with, and that is asset allocation in your portfolio. And we've talked before about asset allocation, and this would make sense as far as asset allocation, because when you are trying to implement a certain asset allocation, what you're doing is trying to take away unnecessary market risk by putting different assets in a portfolio that are not directly correlated with one another. So when one goes up, the other may go down, or if the other one goes up, that one may go down, whatever it may be. Gold can work in that way because, like we were saying, in those really high inflation years, the stock market really struggled, yet gold was flying upward. And so you can see how that is a generally good argument for gold, but yet we still have this view, and I still have this view, gold's not an investment. And we'll talk about why that is as well. So let's talk now. Why is gold not an investment? And so let's think back to when we talked about what investing is and what an investment is supposed to be. Well, we can look at the definition given by Ben Graham and David Dodd in their 1934 book, Security Analysis, and that is a commonly held view of what investing actually is. So let me read that for you if you've forgotten. The investment operation is one which, upon thorough analysis, promises safety of principal and satisfactory return. Operations not meeting these requirements are speculative. And then you may say, well, what's speculative? What's speculation? Well, when you're speculating, you're doing the following. The object of a speculator is not to secure a steady return on his money at a good rate of interest, but to profit by either a rise or a fall in the price of whatever he may be speculating in. And that comes from Reminiscences of a Stock Operator by Jesse Livermore. That's the definition from that book. So you use those two common definitions together, and you can kind of see what we're using as our investment definition and non-investment definition. And so you ask yourself those questions. Does it offer safety of principal and a satisfactory return? Well, let's take a look at that as far as gold. So safety of principal, does it offer a safety of principal? Well, it seems to be the case based on long-term. I mean, one of the first things what we said in this video is that long-term gold has held its value, and other currencies and other different investments have not, as well as gold has. So we can check that box kind of right from the start that, yeah, I mean, the safety of principal can be there with gold. Now, gold has been quite volatile in the long term, and the prices of gold are only determined by the supply and or demand of gold itself. There is no underlying fundamental to gold to which you should say purchase gold. And so given that there's not a profit, or that there's not sales, or that there's not inventories, or that there's not assets and all these types of things, putting that value on gold is not possible. So it's simply supply and demand based on market sentiment, and that does make gold quite volatile. And given that fact, there's really no reason to say that gold should remain stable over the long term. You can't assume that it's going to, even though it has held value in the past. Why should it hold value moving forward? The only way it's going to hold value moving forward is if investors keep treating it the way that they have treated it, and flock to it in times of high inflation or economic uncertainty or things like that. So safety of principal, maybe, yes, we check the box, but there are reasons to believe that in the future, maybe not. Now, what about a satisfactory return? So over the longer term, stocks specifically have handled gold as far as the long-term returns. Now, that wasn't necessarily true in the 2000s, so 2000 to 2010, because we talked about how the price of gold tripled between 98 and 2008, and we had the Great Recession in the 2000s as well as from 98 to 2008, you also saw the tech bubble burst. So the stock market had a tough go of it, but gold did really, really well. But over the longer term, stocks have really given it to gold as far as getting those really good long-term returns. So just for your knowledge, and so we can know the basis on which we're talking about this, let's talk about their long-term returns. Well, over the past 100 years, this is what we've seen from stocks and gold. So over the past 100 years, the S&P 500, the basic index for the stock market, which is the 500 largest U.S. companies that we've talked about quite a bit, the S&P 500 has cumulative returns of over 40,000%, okay? While gold's cumulative returns have only been about 8,500% over the past 100 years. That is a large disparity between those two sets of returns. So on an annualized basis, the S&P has offered approximately 10% annually with reinvested dividends, and gold has offered about 4.5% annually with no income off of them, obviously because there is no intrinsic value to gold. There's no value that you can put on gold that isn't determined simply by supply and demand. So what makes my bold statement of gold not being an investment true? Well, there's no reason to think if I invested in gold today that 30 years from now I would have some satisfactory return in gold. Go look at the gold charts long term. Some investors maybe who have held it for a certain amount of time, or especially prior to the large uptick in prices from 98 to 2008, and then up into the later 2000s. Before that time, gold returns were very minuscule over the long term. And so it's just difficult to think that you're going to put money in gold and be able to get a satisfactory return out, be able to get a decent amount of money out over the long term. And once again, these returns are only determined by the demand for gold and the supply of gold in the market over the long term. And so given that a lot of individuals want to use gold as a hedge for inflation, as a hedge for the stock market being very uneasy, the economy being very uncertain. Given that they want to use it as a hedge, well, we've even talked about bonds being able to hedge against the risk in the stock market to a certain extent. And even though bonds can't do that with inflation, typically with generally normal inflation, stocks will increase. And so it's only those crazy high inflation periods, which we haven't seen in a long time, to where gold really takes the stage. And so we remember a minute ago when we were talking about what an investment is and is not. Well, if something is not an investment, it's speculation. So if you remember back to that definition, what they said was the object of a speculator is not to secure a steady return on his money at a good rate of interest, but to profit either by a rise or fall in the price of what they may be speculating in. Well, if you think about it, that's all people are doing when they flock to gold, is they're saying, well, I'm afraid I'm not going to get a return here, so I'm just going to try to profit from the rise in price and profit from the demand in gold. I don't necessarily have a reason to go to gold. I don't have a basis by which gold is a good investment. I don't have a promise of safety that is guaranteed. I don't have a satisfactory return that's guaranteed. I just know that a bunch of other people are going there, so it's what I'm going to do. I'm going to go there. So people try to profit based on sentiment and not on fundamentals, and not on this promise of safety and a steady good long-term return. And so that's the problem that I have with gold, is the fact that given that you can't check both of those boxes definitively, and the fact that people are only looking at the price when they're trying to invest in it, that's a big issue. If they only want to run up in price, then that's a problem. And that's why I really don't like gold as an investment in that way, and to think of gold as an investment, because if gold were a good investment, then why does it not keep up with stocks? Why does it not even keep up with bonds over the long term? Well, the reason is that it's not an investment at all. It just hangs in the balance on what you and I decide to do. And so if in the next market crash, nobody went to gold, well, gold wouldn't go anywhere. Gold wouldn't have any reason to move. But as long as companies are increasing their profits and increasing their revenues and increasing their asset sizes, all these types of things, and distributing capital to investors, well, their value is naturally going to have to increase. Now, yes, that value in the stock market is only based on people buying and or selling, but there's no reasonable basis to say that a company that's growing should remain at the same price. A company that's growing should increase in price. But why should gold increase in price? There's no basis. You can't say that gold is growing or that gold is doing anything special. No, just more people are investing in it when it increases and less people when it decreases. And that's the only basis that people have for investing in gold. Also, and I wanted to save this, so if my argument to this point hasn't been too good as to why it's not an investment, then you can look into this part of the investment definition and be able to say, well, yeah, gold's not an investment. So if you go back to that investment definition one more time, it says an investment operation is one in which upon thorough analysis. Well, how can you do a thorough analysis on something for which there is nothing to analyze? There is nothing to analyze about gold. If you are investing in gold, you are making some kind of macroeconomic decision. You're trying to make a decision based on the broader economy, for which you and I have no way of knowing what the broader economy is going to do in the short term. So you can't thoroughly analyze gold because there is nothing there to thoroughly analyze. It is a feeling. It is I want to run up in price because I don't think these other things are going to do good. That's not a thorough analysis. And so that said, that is even more reason why you can look at gold and be like, well, that's not an investment. I can't analyze it. I don't know if my money's still going to be there, and the returns have not been great over the long term. Those three reasons are why I hang my hat on gold not being and not meeting that definition of an investment. So it's not an investment, but should we use it at all? And that answer is quite different from, is it an investment? So I want to begin by saying I want as little of your money in speculative assets as possible. Like, I don't want you just going out and running and buying Tesla because Tesla's increasing in price, because that's speculative. And I don't want you to go and run and buy Apple because it increased in price, because that's speculative. I want you to have that thorough analysis. I want you to have a basis for why you invest in things. And it makes sense over the long term to invest in certain things. Now, that said, there's nothing wrong with keeping a very, very small percentage of your portfolio in speculative assets. So, definitely less than 10%, hopefully less than 5% of anything that you have should be speculative. Because we want to make sure that the vast majority of things that we invest in, and really and truly the only things that we invest in, are things that we have to understand and that we have a basis for buying. Because we're not investing in the speculative things, we're speculating. So if your portfolio is made up of a little speculation, that's okay. And what that speculation may do, and this can be the case for gold, and why you can say, I actually do put some money in gold, not invest in gold, I put some money in gold. Why is that? It brings asset allocation to your portfolio. It allows you to decrease the correlation between the assets in your portfolio and decrease some risk. And this is speculating to do so because it's not an investment, but to buy some gold, to have some gold in your portfolio can actually change your portfolio's asset allocation in a way that can decrease some risk and can allow you to do better in down times, and do better when inflation is really high. And so you just have to remember that this is not a way in which we're going to get rich. It's not an investment. It's not what's going to drive us to long-term returns, but it can play a part in your portfolio in that way. And that's really the only reason I would hold gold, is just as a portfolio hedge. Somebody who is a big proponent of doing this, and he's a long-term investor and a long-time investment analyst and hedge fund manager, and now he has a TV show. Jim Cramer says that there is a reason to hold gold as a portfolio asset allocator, and to help spread your assets in your portfolio and decrease some risk. And so he doesn't see anything wrong with that, nor do I. But I agree with him when he says hold the real thing. So if you're going to purchase gold, purchase the actual bullion or the actual bars. Don't go and purchase the ETF. And the only reason is that if you're going to use it as a portfolio hedge over the long term, you're not going to be buying and selling, because that's just not a really smart thing to do. That means you're really speculating in gold because I don't want you even buying and selling stocks. I don't want you trading stocks too much. So even if you do hold gold, there's nothing wrong with holding it in the physical way, because an ETF may go away, because there are ETFs that do track gold, and ETFs may go away, but you will be able to keep your bullion or your bars, and those have been what's been around for a long time now. And a reason that I say we can use it as a piece of our portfolio that is speculative is really based on something that I've learned from Ray Dalio. And so Ray Dalio is a hedge fund manager that for a long period of time has just destroyed the market returns. And so I try to learn from those individuals who do well to beat the market. Well, something that he's done for a lot of his clients is created what's called the all-weather portfolio. And so basically it just means that it's very low volatility, and if you look at the long term, it's basically kept up with the S&P 500, give or take a few years. And in that portfolio, he does have gold as an asset class that's in there. Now he's also got like commodities and things like that, but he's using gold as a portfolio hedge, and that's why I think it can be used. But we have to remember also, it's not for everybody. And if it just confuses you even more, if you haven't known too much or learned too much about investing, I don't suggest dabbling in this way, especially given that if you are going to buy gold bullion or gold bars, it is expensive. It's an expensive thing to do. So I would really keep it simple and not necessarily dig into these sometimes unnecessary portfolio hedges that we may talk about here. And that being said, when I talk about speculative assets and I talk about only keeping 10 or even 5% of the portfolio in speculative assets, I really don't want anybody to be holding speculative assets until they've got $100,000 to $250,000 in their investment portfolio. And that's not to say that you can start playing at that time, because with that amount of money, there's still a long way to go. But that said, what that will allow you to do with that amount of money is decrease a little bit of the portfolio variation if you're trying to hedge with some speculative assets, or if you are trying to purchase some things that you think are just going to take off in price and you want a small percentage of your portfolio to be that, then you have more opportunity to invest in those things and not necessarily rob Peter to pay Paul, and Peter being your nest egg, your good mutual funds, your good value stocks, your good bonds, whatever it may be that you're holding to build long-term wealth. So you're not robbing Peter to pay Paul, which is those speculative assets. So just be very diligent. If you aren't even close to that point, there's no reason to hold speculative assets at all, because these things are not just going to get you rich quick. And not to mention, there is no basis for which you think they should get you rich quick other than a feeling. And that's definitely not enough. And whatever you do, be contrarian. Don't follow the herd. Because the problem that I have long term about gold is that gold is something where people start following the herd. You don't see gold increasing in price when the stock market's doing really well. And why is that? Because when the stock market's doing it really well, everybody's just piling into the stock market. But if there were ever a time to buy gold, it would be when the market was doing well, because gold prices would be depressed. And so it doesn't make sense to me why people want to buy when things are high. I mean, if you're going to buy when something is high, then where do you expect that thing to go? Like, stocks do run out of steam, and assets do run out of steam, increasing higher. Not to mention, the higher you buy, the less return you're going to get. So it is better to be contrarian. It is better to not follow the herd. That will allow you to have better long-term returns. And even when you are speculating, speculate in things that have been depressed, or speculate in things that when the market's doing really well and you want to start hedging your portfolio with some gold, then do it when the market's doing great. Don't do it when the market has stunk and that gold has increased in price beyond belief. So I just want to really urge you to do that and be smart regardless of what you do, regardless of if it's investment or speculation, but keep your speculation to a very minimum. And just know that gold is an asset that is speculative in its nature. So what can we take from today? We're not afraid of a little bit of speculation if we have the assets to do so. And we're also not afraid of gold being used as a portfolio hedge. But what we are afraid of, and what we should be afraid of, is putting our hope and our nest egg and our large amount of funds and the funds that should be working for us long term into these types of things, these types of speculative assets like gold, that can eat away at our long-term returns and not allow us to get to where we want to be. The market, regardless, bond market, stock market, whatever, is going to fluctuate. There are ups, there are downs. That's what an economy does. It goes up and it goes down. But in the long term, a lot of these things, a lot of these good investments, these good diversified portfolios of stocks or bonds, stocks and bonds, whatever it may be, are going to go up over the long term. We've seen it. We've talked about the returns. And so if you are going to add some of the speculation to it, if you are going to add gold as a portfolio hedge, do it in small percentages and do it to where you're still very, very comfortable with the long-term returns of your portfolio. And if you're afraid that the market's going to crash, or you're afraid of the volatility of the stock market and your risk profile is not set for as much market risk as you were taking, then maybe you need to talk to an investment professional about that, and they can help you get into actual investments, actual things that do, through thorough analysis, promise safety of principal and good satisfactory returns that will allow your money to grow and allow your portfolio to be better hedged through asset allocation or diversification. So just keep those things in mind, and you'll be much better off in your investing lifetime. So hey guys, thanks for watching this video. Don't forget to subscribe, like this video, leave me any feedback in the comments. If you're listening to the podcast version of this show, go ahead and subscribe on Apple or Spotify podcasts. Leave me a review. I really want to urge you guys, follow me on social media at MNO with Dylan. I'm putting out stuff every day that I think can be really useful to you guys. Also, if you want to work with me one-on-one in a financial coaching session, you can sign up for that at my website, www.mnowithdylan.com, and we can start a dialogue and just working together consistently. So tune in tomorrow as I speak on another non-investment, and that's going to be life insurance policies. And so I really hope that you guys look into that video and learn a little bit more about why I'm saying these things are not investments. And I just want you to remember, just because I say not investment doesn't mean that they don't play a part in our financial lives. It just means that they shouldn't be the investing portion of our financial lives. So look out for that video and continue to watch all the videos that I put out from this point forward. And we're going to continue growing together and learning together as we go. So thanks for watching this episode of Money's No Object. I'm your host, Dylan Howell. God bless.